Hey, friend, welcome back. As always, I'm your host, Brian Davis, co-founder of Spark Rental, and I'm on this journey with you. Quite literally, I invest my personal money every month in each group real estate investment that we make in our co-investing club. And today we're breaking down private equity funds for beginners, for intermediate investors, and for advanced investors with the help of Pascal Wagner from Grow Your Cash Flow. So, Pascal, welcome and take it away.
Thanks, man. Hey, I think when I got into the space of passive investing, no one sat me down and told me, hey, here is the right way to do it, or here is the way to dip your toe in, to slowly learn how passive investing actually works. Um, so you might, when you get into this space, you might learn about a multifamily apartment building that you can invest into, or a ground up development, or a debt fund, or an oil and gas fund. There's all different types of different things that you can invest into. And usually, how you start is you get an email in your inbox or someone references an opportunity to you, and then you kind of spend time trying to figure out like, oh, do I like this opportunity? Is it right for me? And I actually think, if someone sat me down, I wish they would have told me that there are beginner, intermediate, and advanced funds when it comes to investing passively. To me, uh, when I think of advanced funds, I think of the things that people usually get started with first. Hey, there's this company that you can buy equity in, or you can be an angel investor into, right? Like these are usually, I know quite a few people who kind of get started that way, and that's actually the hardest type of investing in my eyes. There's the most amount of risk in that area. If I were to use an example in the real estate domain, um, you know, building a building from the ground up, having to buy the land, retitle it, actually get the structure built. That is the most significant risk. Your capital is tied up for 5, 7, sometimes even 10 plus years. And so for that to be your first investment, I think is actually incredibly stupid, and it's hard to, you don't, I've been in these deals and I've made that mistake, but I think in the middle of the spectrum, an intermediate type of investment is probably what a lot of people get pitched nowadays, or is probably most common of the type of deal that I see, which is maybe like a value add development where you're buying a property that already cash flows a little bit, like an apartment building. You're going in and renovating the property, doing some exterior paint, maybe renovating the inside of each unit, and then in 3 to 5 years after all that renovation has been completed, then you should see a higher net cash flow coming from those properties. But your money is still tied up. And a lot of the times you basically make an investment and then you kind of just fingers crossed hope that it's working. And in 3 to 5 years, like maybe you'll get your money back. And then there's finally what I actually wish I started with, and that not that I recommend people because I don't know their specific financial situation. I'm not a
Of course.
financial advisor, but if I were to do this over again, starting with these vehicles like debt funds, I actually think are some of the best ways to dip your toe in because, usually they offer pretty high returns, comparatively, 8 to 10%, 8 to 12%. A lot of them do monthly distributions, and a lot of them you can pull your money out relatively quickly. So, for example, a fund I'm in and a fund I promote, the DLP Capital Lending Fund, they do 10% distributions on an annualized basis with distributions monthly. You can pull your money out within 3 to 15 weeks. And, right after investing within 60 or 90 days, you get your first paycheck, right? And so very easily you can come back and 3, 5 months later say like, look, this isn't for me. If you wanted to, and you also kind of get your feet wet with understanding this is a real investment and learning how people communicate and what distributions you get. So I think when I put it all out on a piece of paper. There's the beginner, the intermediate, and the advanced funds. And regardless of where you're at in your investing journey, if you're new to passive investing, um, I kind of wish someone just told me about those three phases and started me at the beginning.
Yeah, that makes total sense. And I love the concept of dipping your toe in the water. That's precisely what we are aiming to do with our co-investing club, is letting people invest, relatively small amounts, 5 grand per person in some of these deals rather than jumping right in with the typical minimum of 50 grand, 100 grand, which makes it really hard to diversify, right? And I like that you pointed out that debt funds can be a little bit more transparent and straightforward for beginner investors in passive real estate investments. The monthly distributions certainly don't hurt, and neither does the liquidity. Out of curiosity, with that fund that you mentioned that you have been promoting yourself, do you allow non-accredited investors in that fund?
I don't. So I've learned quite a bit about the fund world. DLP Capital is a fund that only accepts accredited investors. Their minimum is you have to buy in with $200,000, and a lot of people don't feel comfortable putting in that amount of money into an institutional fund like that. And
Yeah.
so I enable people to invest with 50K. Still not 5K or 25K, but we're limited to people who are accredited investors, and that was kind of the check size that made sense for the fund.
Yeah, it makes total sense. Well, Pascal, in 30 seconds or less, how can you help the listener? What can you do for them? What does your business offer for them? And how can they connect with you?
Yeah. So what I do at Grow Your Cash Flow is I help people earn consistent monthly passive income from private investments. I had to figure out how to do it for myself, my family, and friends, and now I help other people do the same. So if that's interesting to you, you can find me on LinkedIn, Pascal Wagner, or you can search Grow Your Cash Flow.
Awesome. Well, Pascal, thank you so much for coming by. And guys, if you enjoy these quick hit conversations that we have with real estate and other financial experts, please rate, review the show. It means the world to us. And we will catch you next time. Same place, same place.
Like the idea of diversifying into real estate, but don't want the headaches of being a landlord? Enter passive real estate syndications. You buy fractional ownership in apartment complexes and other large-scale properties. Earn your share of rental income and your share of the profits when the property sells. In fact, most of the syndicators we've invested with have average returns over 20% per year. You even get full tax benefits, including accelerated depreciation. Even as you collect distributions in real life, you often report a loss on your tax return. So why doesn't everyone invest in real estate syndications? First, you typically need to know the syndicator to invest, and the minimum investment for each property is high, usually $50,000 to $100,000. That's a lot of money for a single investment, which is precisely why we formed an investment club to pool funds and invest together. Every month, we propose a new deal in the co-investing club and vet it together on a group call with the syndicator. Each deal is purely optional. Pass or invest as you like. As for us, we invest our personal money alongside you in every single deal. If you want to invest like the 1% without actually being a 1%er, join Spark Rentals Co-Investing Club. Email us at support@sparkrental.com with questions, and we look forward to investing alongside you.